to finish the chapter before the end of the night, right? Thank you. All right. So let's do this and see where we come out. And I think by going through these problems, you get a much better idea of what a guaranteed payment is, beginning on page. And you can read revenue rolling 2007-40 on your own. It's whether or not, look at this issue on 2007-40. If the transfer of partnership property to a partner in satisfaction of a guaranteed payment under Code Section 707C, a sale or exchange under Section 1001, or distribution under Section 1031. And what is a guaranteed payment? It's a fixed amount, right? It's a fixed amount. And if you owe someone a fixed amount and you pay them with appreciated property, what do you think happens, guys, even if you haven't read this? Gain recognition, a Keenan-like gain. K-E-N-A-N, you remember Keenan? And if you make a payment with appreciated property, that you have a Keenan-like gain. So if you satisfy, if you need to satisfy a guaranteed payment and the partnership utilizes appreciated property, it's going to result in a gain recognition event. All right. The authors in the note says that recently there are several proposals to repeal Code Section 707C, and instead of treating partners as this guaranteed payment, they would just simply say, hey, if you get a fixed dollar amount, no matter what, you're treated as a non-partner, a 707A1 payment. That's been proposed many, many times, never passed. So for our purposes, I would be derelict in my responsibilities to you if we didn't talk about Code Section 707C, because 707C could be repealed next go around. My suspicion is it's going to be here for much, much longer. So look at page 247. We have the AB partnership is in a quote unquote highly speculative, I have the word speculative highlighted in red, business which profits fluctuate widely. For the current year, the partnership has profits of $20,000, of which $12,000 is ordinary income, $8,000 is long-term capital gains. A and B share profits and losses equally unless otherwise provided. A renders services to the partnership which are continuous related to the function of the partnership and not in the nature of a capital expenditure. Okay? Why do they say it's not the nature of a capital expenditure? Because they want to make clear Code Section 263 doesn't apply. They're not just here to waste toner, right, guys? Question A. What results in A and B, meaning the partners and the partnership, if A worked for the partnership and was required to be paid $15,000 per year for service regardless of the income of the partnership? Let me just get a gut reaction here. In this case, Ankin, do you have an answer? Do you have an idea of how you might treat this? You're still looking? Busy? Just say it loudly. So Jonah, you agree? Guaranteed payment? Right. It says no matter what the partnership income is. Agreed? Right. So it's going to be a guaranteed payment. Now that we've described it as a 704C payment, A is going to get $15,000. What kind of income? Natasha? Ordinary income, right? Natasha, what are the other implications once we decide it's a guaranteed payment? Natasha, you're going to say? Hey, it's a $15,000 guaranteed payment, right? Ordinary income. Any other implications here? Michael, you have your hand up? Just say it loudly, even louder. Partnership will get a, what kind of $15,000 deduction, right? Right? Code section 263 does not apply here. So what does that leave? Negative 3,000. And that's ordinary loss. And 8,000 a long-term capital gain, right? And that's going to be allocated 4K each. And the ordinary loss, 1K each, right? Great?
What's that parentheses that you have?
That's a $1.5 thousand loss.
Isn't it 15?
Well, this is, the partnership gets a $15,000 deduction, but it had 12,000, right, of ordinary income. So 12 minus 15 is the $3,000 loss, right? Everyone have that? Question B. What results in A above if the A services relate to improvements on the land owned by the partnership? What does the word improvements connote?
Capital.
Capitalize. Capitalize. So don't say it out loud. Everyone write some numbers down. And it's exam time, you're just writing some numbers down, hopefully the right ones. George, you had your hand up.
Yes. So each one is going to get 6,000 ordinary income.
All right, just be careful, just do your analysis. What were you gonna say?
So the guarantee payment is going to be 15,000.
What's gonna be 15,000? I apologize.
Sorry.
Let me just,
Sorry. Messed up the numbers.
Finale? Have an idea? Have an idea? Is this guaranteed payment?
Sorry.
Why not? Not sure?
Sorry.
Kevin, guaranteed payment? Hey, yeah? PK? You think it's not? Why not? Guys, it's guaranteed payment. Well, I'm not quite sure why you would change your mind. Still guaranteed to get 15,000, right? The fact it's deductible or not deductible to the partnership has no bearing, right, EK? So it's still 15,000, right? Everyone agree? A's going to be tagged with 15,000. 15,000 guaranteed payment. That's 15. Ordinary income, right? Partnership. Is partnership allowed a deduction here? No. Right? So that being the case, what kind of income does the partnership still have? 12, right? Ordinary income, and it has 8,000, right? Capital gain. And that's going to be divvied up, right, to each partner, right? 6K each and 4K each.
Can't you deduct like 1/15 of that expense, of A's expense? Like
Well,
$1,000?
we don't know what's the useful life of the improvements.
Okay.
So we don't know if it could be depreciated over the lifespan, I don't know.
Okay.
But for now, we're just gonna say it's non-deductible capital improvement. Everyone got that? A and B, in both instances, there's a guaranteed payment, right? Feels like it, right? Because A is said to get the first 15,000 no matter what income the partnership has or doesn't have. What results if A renders services under agreement that he will receive $15,000 for 50% of the partnership profits before taking into account the guaranteed payments, whichever is greater, and the profits are $20,000, consisting of $8,000 ordinary income and $12,000 ordinary and $8,000 capital gains. Sound familiar? So think about this for a second. We're going to do this problem in two ways. We're going to do this as it's reported in the regulations currently. This is going to be in Regulation 707-1C, Example 2. I'll repeat, 707-1C, Example 2. And from the revenue ruling, 69-180. And then we'll talk about how the new rules might apply. So let's talk about how this is treated under the old and new. So A is entitled to 50% of the profits before taking into account any guaranteed payments. What's 50% of the profits, guys?
14.
He's entitled to 10,000, right? The profits here are 20, right? He's entitled to 50%. So he's entitled to 50% of 20, last I checked, is 10. But he's entitled to, aside from the profits of the partnership, a guaranteed payment of 15. Everyone agree? So under the old rules, the rules as they exist today, when I say before we get into the proposed regs, the guaranteed payment, if you look at that example in the revenue ruling, 69-180, the guaranteed payment here is how much? 5,000, right? Because he's entitled to 10,000 just as part of his distributive share. Everyone agree? He's entitled to 10,000 as part of his distributive share, but he can pound the table and demand 15,000, so $5,000 is considered a guaranteed payment for ordinary income to A. Yes?
10,000 is the guaranteed payment.
No, I didn't say 10, I said 5.
But he has
He's
to pay-
entitled to a 10,000 distributive share. 5,000 is the guaranteed payment. I'm not making this up.
All of it be guaranteed?
What was that, Nate?
Shouldn't all of it be guaranteed because it
Right,
says?
but that's under the new rules.
Oh.
Okay, but under the current rules, and if you read if you go to your regulation book, guys, and you look at revenue ruling 69-180, I'm not making this stuff up. This is how it is under the rules as we have them in our book and in the regulation. But B, your instincts are right, and that's why the rules have changed to make it 15. But let's just go through what the existing rules say. So the existing rules say 5,000 is the guaranteed payment. And if 5,000 is the guaranteed payment, what does that leave the partnership with? Well, how much was the ordinary income before? It was 12, right? So we subtract 5, and that leaves 7,000 of ordinary income, right? And what was the capital gain? 8,000 of capital gain, okay? And we know how much is A entitled to? A is entitled to $10,000. Everyone agree? 10,000 of this 15, right? This equals 15. Everyone agree? A is entitled to 10,000 of that 15, or 10/15 times 7, and 10/15 times 8. Because if you do the arithmetic here, 10/15 of 7 is 4,667. And 10/15 of 8 is 5,333. What do you think the total is here, guys, of both? $10,000, right? So, under the rules as written now, A would have a $5,000 guaranteed payment, and his distributive share would be $4,667 of ordinary income and $5,333 of capital gain, which together total $10,000. What do you think B would be entitled to? B gets sloppy second, whatever's left here. B would be entitled to $2,333 of ordinary income. Okay, that's just the remaining balance of the ordinary income. And then how much capital gains, guys? 2,667 of capital gain. What do you think the two of these equal, guys? $5,000. Which makes sense. The total income, right, was 20, A was insured 15, and this is how the rules under the regulations and that revenue ruling, this is the correct answer. Now, the new rules would simplify this. So this was what V was alluding to. Under the new rules, we would have a very simple equation. A would be entitled to a $15K guaranteed payment, all ordinary income. And what would happen to the partnership? We'd be back to our old 3,000 ordinary loss, 8,000 long-term capital gain to be split equally between the partners. Everyone got that? And if you look at your book and you say, I like that, right? Renee, you like that, right? Because it's a lot easier, and I'm not faulting you, I agree. This is on page 245 of your textbook. But I am sharing with you, go through that revenue ruling, the 1969 revenue ruling, you look at example 2 in 707-1C, example 2, under the regulations. And by the way, the examples under the regulations, guys, unlike where we're doing substantial economic effect, they do not go on page after page after page. The examples, good news, half a page, guys. How do you like that? 4 examples in half a page. That might be under substantial economic effect, 1/4 of one problem, but not here.
Professor, are you gonna tell us all new, whatever it is,
You could use either.
Oh, yay.
Say again, Michael? You should know both, but I don't mind if you use the new, right? This is 2019. All right, question C. Well, we just did question C. It was so good, I figured we'd talk about it again. And question D, we just did. Look at us. All right, look at us.
Can you go back to that page one more second? Thank you so much.
So this is question D. Right, which is very reminiscent of question A. Question 2. Jordan, you okay?
Yes, thank you.
G, the cash method taxpayer is a 1/3 partner in FGH accrual method partnership. So we have a cash method taxpayer is 1/3 in accrual, which is not unusual, right? Generally, partnerships can be accrual. Most taxpayers most of us mortals are on the cash method, right? G is employed by the partnership and is entitled to a guaranteed payment of $10,000 for year 1. G's outside basis for year 1 is 0. G's agreement with the partnership specifies that he will receive the $10,000 guaranteed payment on June 1st of year 3. On January 1st of year 2, the partnership sells an asset, basis 15, fair market value 15, so there's no gain, right? There's no gain. And it's going to distribute $5,000 to each partner. What result to G? So G apparently, let's just take the guaranteed payment that G gets and is entitled to in year 1. Okay? Is G taxed on it? Not going to receive it until year 3, but is G taxed on it in year 1?
No.
Remember, it's treated like a distributive share, right? Guaranteed payments, even though it's guaranteed, it's still treated, right, for tax purposes as a distributive share, and therefore, yes, the partner G would be taxable in year 1, even though they didn't receive it. Because for partnership tax, 704C treats it as if it were a distributive share, and for timing purposes, if the partnership year closes in year 1, you have to include the guaranteed payment in year 1. So our taxpayer, even though they don't receive the guaranteed payment, G would still be taxed on that.
Even though he's only cash method.
Doesn't matter. Remember, you can be a cash method taxpayer, right guys? For partnerships, you're going to get K1s and you're going to be taxed on a lot of income that's not distributed to you, right, B?
Okay. Yes.
Everyone agree? Do not be befuddled by that. Lots of cash method taxpayers are, as a partner, you're taxed on whatever income accrues when the partnership year closes, right? BK, you okay?
Yeah, I have one question. What's the
Just say it loudly.
What's the difference between 707A and guaranteed?
Well, the guaranteed 707A doesn't mean you're entitled to first of all, as a guaranteed payment, you're functioning in your capacity as a partner. In 707A, you're not functioning in your capacity as a partner. You're functioning as a non-partner. Okay? And for timing purposes, guaranteed payments treat you for timing purposes as if you were a partner. Okay? So in this case, for your notes, our taxpayer is taxed in year 1. Now the question is, what happens to their outside tax basis, right? Okay. What happens as their outside tax basis? Okay, and this raises the rhetorical question. Does the partner's outside basis go up by the amount of the guaranteed payment, right? In this case, the guaranteed payment is $10,000. Or does the partner just simply have a tax basis in their guaranteed payment, right? You think the outside basis goes up. What's your authority? Footnote 16 in the gains case, right? Footnote 16 in the gains case. So is that a footnote in a tax court case? It's not a U.S. Supreme Court case. Doesn't mean that's the final answer, okay? But this helps the taxpayer, right? Because when they get a cash distribution, if it were my client, I would argue you're just going to reduce your tax basis because you'll see, Code Section 731, when you get a distribution, generally, unless you get a cash distribution in excess of basis, you don't have income. But if you get a cash distribution in excess of your basis, you will have income. So this taxpayer would like to take the position that their outside basis went up to $10,000. Agreed? And therefore this distribution would not trigger income. So if your notes, at least we have some authority for the proposition that the outside basis went up by the income recognized in the form of the guaranteed payment. question 3 raises a question, in a situation similar to revenue ruling 69-180, is it possible for amounts paid to a partner in excess of the guaranteed payment to be classified as a 707A1 payment? So,
Professor
and-
Solit, did we talk about the $5,000 or did I zone out?
well, you might have zoned out, but
Okay.
the distribution of the 5,000 means that if they have an outside basis of 10,000, and you get a distribution of 5,000,
It
it's
goes
just a
down to
return of
5.
basis.
Okay.
But if there was no outside basis increase, that you had a basis in your intangible known as your guaranteed payment of 10,000, then that distribution could have triggered a $5,000 gain.
Okay. Thank you.
Okay? Question 3. The question is, can you have 707C guaranteed payment and amounts, and if your guaranteed payment, say, is 10,000 and the partner is entitled to 30,000, can that excess 20,000 be considered a 707A1 payment? Okay? Everyone got that? That you get a guaranteed payment of X dollars, and now you're being paid X plus Y dollars. And rhetorically, I think what the authors are raising here is that, look, you could be functioning, right, EK, in your capacity as a partner and get a guaranteed payment of X dollars, but other work you do in excess of that could be in some capacity that's not related to the partnership, and it could be a 707A1 payment. So for your notes, remember, when you're wearing your partnership hat, you could be wearing one of 3 hats, right? You could be wearing a hat in which you're truly not a partner, you're functioning as an independent contractor, agreed? You could be functioning where if I'm partners with Viva and Ken, and I sit and say, look, I have some valuable services here. I don't care how well this partnership does, I want to be paid X dollars from the partnership. That's called a guaranteed payment, so it can have that hat. And the third hat is if Ken, Viva, and I function as equals, and I just want my fair share, we're going to split profits. Maybe Ken gets 40%, Viva gets 30%, and I get another 30%. All that's possible. That's the third possibility. So, and they can coexist in the same universe. That payments can coexist. It's not one or the other. That we can have multiple kind of payments being made. So just leave it at that. Question 4 is more interesting. Partner renders services worth $10,000 to a partnership in which he is a partner. Okay. Without regard to partner services, partnership would have $75,000 of ordinary income, $25,000 of long-term capital gain. Both partner and partnership are counted as taxpayers. The partner uses the cash method of accounting. Partnership uses the accrual method. Right? We've seen this before. Been there, done that. Right? Partnership does not make payment during the year to partner during the year, but we're permitted to accrue the expense, which is currently deductible under 162. Determine the tax consequences in the alternative situation. In recognition of his services, partners allocate the first $10,000 of partnership profits, which is treated as part of his distributed share. Okay? So, what's going to happen here? Well, what do you think, guys?
It's a guaranteed payment.
Well, it doesn't say he's going to be allocated. It doesn't say he must get minimally $10,000. Everyone agree? So I don't think you want to call this a guaranteed payment. Well, yeah, I think you got it. I don't think it's a disguised payment because he's subject to all the risk. Okay? I don't know in this context if sometimes partners do perform extra work, and you can't de facto say every time someone does it, it's a disguised payment. So I'd be hesitant in the absence of more facts to say it's a disguised payment. I just think he's gonna, special allocation, right? It's gonna have substantial economic effect. His capital account's gonna go up by 10,000. The world is happy. All right, now the question is, we're gonna allocate, right, the first $10,000 of this income to him. What was that gonna do? It's gonna reduce the ordinary income to $65,000, right? Excuse me, I apologize. I get to invoke the after 8 o'clock rule. He recognizes the first $10,000 of income. What kind of income does this partnership? I should have wrote this out. I got ahead of myself. 75,000 ordinary income and 25,000 capital gain. Well, if that's the case, right, guys? If that's the case, he gets 10% of that, right? Because with a distributed share, you have to get pro rata unless there's some sort of special allocation. Then you got to be careful about shifting and transitory. So in this particular case, you should get 7.5 of ordinary income, 2.5 of capital gain, and then whatever remains, which will be 67.5, right? We could all handle the math. And 22.5, okay, of ordinary income, capital gain. Okay, that will be allocated however the partners decide. The important takeaway here is just that, hey, he's getting a distributive share of the first $10,000, and it's not a guaranteed payment. If it were, it would be all ordinary income. He's just getting the first $10,000 distributive share, right? This is the third tier, right? This is the third tier. The first tier being 707A1, second tier 704C, excuse me, 707C, guaranteed payment. Third tier, just regular distributive shares. When you get a distributive share, you absorb whatever the character of the partnership income is. Question B. 707A applies because services are unrelated to the everyday conduct of the partnership's activities and are non-continuous. And EK, you'll appreciate, and B too, that in problem 1 or problem A, even if no distributions are made, our partner is going to be taxed on this, right? No matter what. Even though he's a cash method taxpayer, right, Jack, we're still going to be taxed. Agreed? Question B. The services are unrelated, so the authors are just illustrating our first tier, 707A. And in that particular instance, what's going to happen? In year 1, can the partnership get a deduction? No. Why? Say it loudly, George.
The partner has to include his income.
Right, you didn't include an income. So code section 267, right, A2 says nope. So it's going to be $75,000 of ordinary income and $25,000 capital gain, right? Has to be allocated. Right? You can't have a mix match. Question C. Now we're getting to guaranteed payment because the services are ongoing related to the partnership activities but are paid without regard to the partnership income. So this has a aroma, a guaranteed payment. So what happens here? Here, our partner has to include an income, right? For timing purposes, a guaranteed payment is treated as a distributive share, right? Guaranteed payment is treated as a distributive share. So that leaves 65,000 as ordinary income $25,000 K as capital gain. Right? So, again, the partner must include it, the guaranteed payment as income in year 1. Question D. Partner is allocated $10,000, which is treated under 707A2A as a 707A1 payment. So, Michael, you'll appreciate this. And maybe it is some sort of disguised payment. Probably isn't, but maybe there's other facts we learn about that make this a disguised payment. And were that the case, guess what? We have the same outcome as in B. Because that's the whole purpose of 707A2A, right? Is to treat it as if it were a payment to a non-partner. All right, so we have our 3-tiered system. Everyone's got that? Not that bad, guys. If you go back through this, I think you can get it. I'm hopeful or optimistic, sanguine. Think of your SAT work that will work here. Let's talk. I'm going to give you 1 or 2 takeaways now. Simple rules of thumb that hopefully will serve you well throughout your career when it comes to partnerships. How's that? Worth the price of admission, I hope. Here's the takeaways that, maybe you won't remember some of the nitty gritty, but this you should remember. If a partner receives a capital interest as a result, right? Chapter 2, we talked about the contribution of property and the fact that generally the contribution of property is not taxable. What's my authority? 721. Everyone agree? But the contribution of services does not qualify, right? Contribution of services does not qualify. And that's, by the way, very similar to Code Section 351. 351, if you contribute services to a corporation, can't qualify for tax-free treatment. Everyone agree? So, very similar. If you contribute services, generally, and you get a partnership interest, generally. And here's the takeaway. In this world, beginning on page 248, if you receive a capital interest, in other words, as a result of performing services, your capital account, okay, your capital account, you get to enter the partnership. And I'm not talking about your outside basis, I'm talking about your capital account. The partners designate that you now have a capital account of $100,000. That's a capital, right? That's a capital interest, right? When your capital account goes up, that's a capital interest. Everyone agree? Do you think that should be taxable or non-taxable?
It's taxable.
Yeah, everyone agree? Taxable. I know it's a little late, so it can't be as dramatic, but be pounding on your table if this were 8 o'clock in the morning, saying taxable, because, heck, you're now entitled to $100,000, right? Capital accounts mean something, right? Or they should mean something. And you feel, right, Code Section 61, you should feel $100,000 richer, and as a result, taxable. Agreed? So one takeaway for tonight, among others, is that the receipt of a capital interest generally is taxable. And again, no one's falling off your chair because that makes sense, right? No buts. Well, by way of comparison, how's that? If you receive a profits interest, okay? A profits interest where someone says, listen, you can join our partnership, but you're not entitled to anything that the partnership owns, but if the partnership makes profits, you're entitled to X percentage of the profits going forward. Everyone got the contrast? In the first scenario, capital interest, you have an economic stake in the enterprise. What's your capital account if you get a profits interest? That's what I want to hear. The big zero. Do you feel richer if you get a profits interest in a partnership? You shouldn't. You might feel good, right? Because heck, you're going in optimistically that the partnership's going to make some money, and if it does, you got skin in that game. But if it doesn't, you don't, right? So there's no Congress and the regulations are patient in this context and say, look, if you make money, or the partnership, I should say, makes money and you're entitled to a share, we'll tax you then. Right? So everyone understand this bigger picture, right? The big picture. Let's get the big picture. And if you have an equity stake, capital interest, generally taxable, profits interest, as we're going to learn, generally not taxable. Okay? That's the big picture item here. And generally, what's the character? So let's do the capital interest first, beginning on page 249. If you receive a capital interest, what's the character of that income?
Ordinary.
Ordinary, right? There's no sale or exchange, right, V? Doesn't qualify under Code Section 1222 as a sale or exchange. There's no 1001 exchange. So your receipt of the capital interest in return for services is ordinary income. When do you have to include it in income? Generally, if you look at Code Section 83, Code Section 83 says if you perform services, generally your tax on it, if you open up to Code Section 83, might as well open it up to Code Section 83. The takeaway from Code Section 83A is you're taxable on property when those interests are transferable or not subject to a substantial risk of forfeiture. I'll repeat, you're generally taxable when you perform services. Anytime, whatever you receive, you can transfer. You have a right to transfer it, or it's not subject to a substantial risk of forfeiture. So if a company says, listen, if you work here for 5 years, this capital interest will vest with you, but if you leave or we fire you within 5 years, that capital interest is not yours. Should you be taxable immediately or after 5 years? After, right? Because the first 5 years, it's merely a promise to pay you this, right? Everyone agree that from a timing perspective, if there's a real risk of forfeiture and you have no right to transfer it, it equates to a mere promise. And generally, you're not subject to tax on mere promises, right? Everyone agree? You can make what's called an 83B election. What is an 83B election? It allows you to accelerate and take it into income immediately, even though it is subject to this risk of forfeiture. And you might say to yourself, excuse my language, who the heck would take it into income immediately? And Michael and Ramon, why would you elect to take it into income immediately? Just say it loudly. That's loud? All right, you might want to take income, 100,000 into income now, and make an 83B election, because in 5 years from now, if it's Google or Lyft or some other startup company, and you think that 100,000 is going to be 100 million 5 years from now, better to take it into income now, okay, than to take it into income 5 years from now and pay tax at ordinary rates 5 years from now, right, on that income. So you can make an 83B election. The price tag, Michael, for making an 83B election, but you have to pay tax now, but what's the other downside? You can't take the loss, right, Chrissy? That if You do forfeit your interest, poof, no deduction. So there's a risk here. It's not like, oh, just make an 83B election, what the heck? The downside is you can't take a loss if and when that happens. All right, so 83B elections have to be carefully weighed, and you've got to make sure your client is aware that there is a downside here. Okay? So the authors describe 83A, 83B. If you do make a payment, if you do give a capital interest to a new partner, once again, Keenan comes into play. So if you give appreciated property, okay, as part of the capital account, we'll see in a moment, that can result in a Keenan-like gain. So what happens in the famous McDougall case? Anyone have a chance to read this? Who said, gee, I like horse racing, so I love reading about this case? Any horse racers out there? All right, you guys want to hear more of me? I'm not sure if you do or don't, but I don't want to put anyone on the spot. So here we have taxpayers, I should say. There's a husband and wife. They owned several horses. They hired a trainer. The trainer discovers this great horse and said, look, I know this horse looks a little sick, but I think if you make the investment, I can give this horse, make this horse, recover this horse, make him fully what he's meant to be, great racehorse. And even if he isn't a great racehorse, he has a great bloodline. You can use him as a stud. So one way or another, it's worth your investment of $10,000. So this trainer, I don't think he was a vet, he was just a trainer. The trainer convinces the taxpayers to make a $10,000 investment, and they say to him, look, if this horse proves to be as successful as you say, as soon as we recover our $10,000, we're going to be equal partners in this enterprise, essentially. So they agree that they're going to be equal partners, and what happens here is that the horse does prove wildly successful, and they join forces. They give him, I'll say it like the case doesn't make it quite clear, they give him a capital interest, right? They give him a capital interest of 1/2 the value of the horse when everything falls into place. And the question is, what are the tax consequences to him and the partnership of his receipt of his capital interest? Okay? What is the tax consequences? And one thing is, when they give him 1/2 the horse, which he then contributes to the partnership, if you look on page 255, the second full paragraph, on page 255, they have a deemed, the husband and wife have a deemed gain here, a Keenan gain. Notice the citation to Keenan at the very end of that second paragraph on page 255. So they give him a horse, 1/2 the horse is worth $30,000. Their adjusted basis in that 1/2 of the horse is $5,000, right? Because originally they bought the horse for $10,000. Remember, they bought the horse for $10,000. So when they give him half the horse, under Code Section 1001, their adjusted basis in 1/2 the horse is 5. The fair market value is 30, and they have a gain of 25. What is the effects to the partner? Well, he has $30,000, right, of income because he's being paid for his services. He's getting a capital account worth $30,000, and the partnership gets a deduction, right? The partnership gets to deduct this $30,000 payment as an ordinary and necessary expense. This is at the bottom of page 256. It points out that they're entitled to a $30,000 deduction. So there's several things happening. Let me summarize again. The effects to the people who owned the horse originally before the partnership. By attracting the trainer, they are giving him, to satisfy their obligation, 1/2 of a horse worth 30 with an adjusted basis of 5, resulting in a Keenan-like gain of 25. They are also paying him the equivalent of 30,000. So not only do they have $25,000 of income, but they also get a $30,000 deduction. And the recipient here, meaning the trainer, has $30,000 of ordinary income because he had his capital account went to $30,000. And we're going to see a problem or two just like this, so fear not, you will see that. I just want to point out to you that often on page 257, 258, our authors in the note that follows talk about practical considerations. I just want to point out to you on page 258, the last sentence. As a result of these practical, administrative, and liquidity burdens, partnership capital accounts are rarely issued as part of the equity compensation packages. So, what I'm just going to call to your attention is that generally existing partners do not run to give new partners equity interests in partnership enterprises, okay? Just not usually the case. But sometimes that can happen, and if they do, let's talk about the tax consequences enumerated beginning on page 258. Let's just take a look at these questions because they're not hard questions to answer. C is offered a capital interest in a partnership whose sole asset is a commercial building with a fair market value of $150, adjusted basis of $90. The building has been depreciated on a straight line method. A and B have $45,000 outside basis in the respective partnership interests. C has performed real estate management services for the partnership over the past year and has agreed to perform additional services in the future. What are the tax consequences to C and the partnership, A and B, if in year one, C receives a 1/10 capital interest as compensation for its management services for the past year? So let's just talk about some general precepts here. Does this qualify for tax treatment, tax-free treatment under Code Section 721? And the answer is no. Everybody agree? Will not qualify for tax-free treatment because it's the contribution of services, not property. Okay? When is this taxpayer, what is he going to be taxed on, the partner C?
15,000.
15,000, right? Because Code Section 83, he gets the interest immediately, is not subject to risk of forfeiture, there's no issue here. So, and he's being paid for deductible services, right? Everybody agree? Being paid for deductible services, therefore the partnership's going to be entitled to a $15,000 deduction, right? $15,000 deduction. But there's a Keenan-like gain, right? Because the fair market value is 15, the adjusted basis is 90. What's 10% of that? 15 minus 9, right? Equals $6,000 gain, right? Because isn't that what they're using, appreciated property, to pay him? What kind of income is this? Just you guys, to amuse you. It's unrecaptured 1250 gain, right? Because it's prior depreciation. Remember from income tax that this is unrecaptured 1250 gain. But put that aside. Let's just talk. We're told A and B have outside basis of how much each? 45, right? And they're going to get a deduction rate of 7.5 because they're paying this guy for his services 7.5. But there's also gain recognition. We said they're going to have to take into income 3,000. So where does that leave their outside basis? At 40.5, right? Everyone see that? They're paying him 15,000, right, for his services. That results in a $15,000 deduction, one half each. But they have a Keenan-like gain of $6,000, allocable $3,000 each, right? What's C's outside basis, guys?
15.
15,000, right? So, just to complete the package here, you have assets of B, 90%, a building of 10%, I don't know what I just did here. Okay, I'm just giving you a simple balance sheet. Okay? There's a building with an adjusted basis with an embedded gain. And remember, C is contributing back 10% of the building, right? So that's why the basis and fair market value in both instances are 15, right? C is being paid with a 10%, picture a 10-story building. He's being paid with 1 story of that 10-story building, which he's contributing back to the partnership. Agreed? All right, so that's the answer, guys. Let's not belabor this. That's the answer. Question B, what results in A if C receives his capital interest in exchange for legal services performed in connection with the acquisition of the building? Does C have income?
Yes.
What kind of payment is this, guys? Say again? What kind of payment is this? This is a 707A1 payment, right? 707A1. And it's not deductible in the partnership, right? Because it's 263, it's got to be capitalized. So C still has 15,000 of ordinary income, right? And now, and he has 15,000 outside basis, right? Right? Because it's going to be, but now it's not deductible to the partnership. Everyone agree? It's not deductible to the partnership. Now, we're still going to have a Keenan gain, right? We're still going to have a Keenan gain of 6. Everyone agree? They're still using the appreciated building. So once again, our balance sheet we have that non-deductible cost, so we have 81,135, 15, 15, 15, 15. That's the non-deductible, right? A, B, and C. Remember, they had outside basis of 45. It went up by 3,000 apiece, right? Because of the Keenan gain of 6, 3,000 apiece. A and B, their basis went up. So that's the answer. Question C. What result in A above if C receives his interest as compensation for services to be rendered in the succeeding 3 years, provided, however, that if C ceases to render the services before the end of year 3, C or any transferee of C must relinquish his interest in the partnership. Assume for this problem, the building will have a value of $450,000 and an adjusted basis of $90,000 at the end of year 3. What is the author's point here? Would you make an 83B election here? If you make an 83B election, okay? If you make an 83B election, what's going to happen? Same as A, right? The outcome is the same as A. Everyone agree? If you decide to take it into income immediately, same as A. That's the answer. But if you don't elect, you don't make an 83B election, what will happen at the end of year 3? Now the building is worth what? $450,000, right? If you give away 10% to pay that partner, what's going to be your Keenan gain? 45 minus 9, right? What's that going to do? You're going to have a $36,000 gain. Everyone agree? And how much income will partner C have? Partner C, right? Partner C is going to have how much income? He's going to have $45,000 ordinary income, right? And the partnership, of course, would then get a $45,000 deduction, right, for payment for his services rendered. Right? Give me 5 more minutes. Let me just cut to the chase with the profits interest, guys. I made the point clear that generally profits interests are not taxable. Everyone agree? Now, if you don't believe me, look at the Hale case. The Hale case on page 259, look at footnote 3. Under the regulations, the mere receipt of a partnership interest in future profits does not create any tax liability. Period. Okay? So the receipt of a profits interest generally not taxable. Now what happened, so that seemed to be good law for decades. For decades, not taxable. However, page 260, the Diamond case, without getting into the nitty-gritty, what happens in the Diamond case is someone gets a profits interest and they sell it very quickly after they get the profits interest. It's not even clear they were acting truly as a partner. But for the first time, the court has to confront the reality is there's nothing in the code that really says not taxable, but people, it was folklore. You had a mere profits interest doesn't feel like you have real income. But if you have a profits interest and you actually get paid the next day for it, if you sell it, well, it suggests that it really did have a fair market value, right? So Sol Diamond creates this earthquake that says a profits interest upon its receipt to be taxable. And it truly creates an earthquake. And ultimately, it scares everyone, and the service issues ultimately to calm everyone. Revenue Procedure 93-27 on page 269. And its takeaway, and this is an important rev prop, says the receipt of a profits interest is not taxable, except in 3 very, 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 did I say very, very narrow circumstances beginning on page 270. That if the profits interest on the page 270, 1, 2, and 3, if the profits interest relates to substantially certain and predictable stream of income from a partnership assets such as income from high quality debt, that could be, profits interest could be taxable. If you sell within 2 years of receipt, could be taxable. And if you deal with a publicly traded partnership, okay, we're not going to worry about 3, okay? So it's very, very narrow. Look at problem 1 and 2 on page 271, because we can answer this almost with our eyes closed. On page 271, problem 1. The AB partnership is a law firm. C, an associate in the firm, is offered a 1/3 partnership interest in the future profits of the partnership. He's not required to make any capital contribution. What do you guys think? Taxable or not?
Nope.
No, come on. Many of you are going to be offered to be partners, right? In a partnership, an accounting firm. You wouldn't expect a tax bill day one. You're just keeping your fingers crossed it's going to make some profit. So your answer, problem 1, not taxable. Question 2 on page 272. C, an experienced real estate manager receives a non-forfeitable 1/10 profits interest in a general partnership. Your sole asset is a commercial building with a value of $1 million in return for his agreement to render management services in his capacity as partner. The net rentals for the building have averaged $100,000 per year. So it looks like he's going to be entitled to about $10,000 a year because that's the profit. He's asked to manage the building with the hope that his expertise will increase the rental income and ultimately lead to a profitable sale. What are the tax treatment? Okay, what is the tax treatment upon his receipt? Now, is this profits interest, does it fall within the scope of either of those exceptions, guys?
It looks like number 1.
Well, it might, but this is not like, you know and I know, today something is worth a lot. It's not like a high quality debt instrument. This is commercial real estate. And you could lose one of your big tenants and poof, you wouldn't get that rental flow. All right, so the answer is no, not taxable. And again, the IRS is very gingerly, has promised very gingerly to invoke this revenue procedure, only in very unique circumstances. So your answer to 2A, not taxable. Question 2B, what are the tax consequences to C upon receipt of the profits interest if C, prior to becoming a partner, rendered services to the partnership in connection with obtaining financing and soliciting clients? Once again, not going to be taxable. Not going to be taxable because it's a mere profits interest. And in question C, what if it resulted in A, if C sells his profits interest for $50,000 within 1 year of acquiring it? In Tenabells, right? Then the IRS can invoke the revenue procedure. In this rare circumstance, this may be taxable, okay? May be taxable. Remember, the revenue procedure is a safe harbor. If you fall outside the scope, doesn't mean you're always going to be taxable, but it suggests it would be taxable. What about question D? What result to C enter the partnership in A above if C's profits interest was subject to forfeiture until C rendered the services for the partnership for a period of 5 years? Okay? Well, what's the takeaway from this? Again, not taxable. And even when it vests 5 years later, guess what? Still not taxable. Right? The profits interest, if you get it today, or even 5 years from now, when it vests, not taxable. So, for exam purposes, Renee, taxable or not profits interest? Generally not. I don't want to say categorically NO, but generally not taxable. Compare, right, to a capital interest, right? Capital interest generally taxable, right? So the rest, Renee, you'll be happy. You're not responsible for anything to do with carried interest that is at the end of this chapter, okay? So no questions on carried interest. We'll begin 2 weeks from today on chapter 8, but that's for another story. Good luck studying. I'll be around. Thanks for your patience tonight. Good luck. We'll see you next week, okay? And those on WebEx, everyone have a good night on WebEx. Good luck studying on WebEx. And, we'll talk to you guys. So everyone on WebEx, good luck. Any questions, let me know. And you guys have a good night as well, okay? So I'm going to exit out of WebEx. Have a good night, guys.